In this week's video, we'll review the latest charts and data to help us answer the question, are the charts rolling over in a concerning manner? It's a daily chart of the S&P 500 that we covered in last week's video. It's dated February 21st, 2025. The purpose of the chart was to remind us that volatility is 100% normal and to be expected. Hypothetically, at that point, we said if the S&P 500 backtracked to roughly 5,800, that would represent approximately a 6% decline from the recent closing high. And even if we went all the way back to 5,600, that would be less than a 10% decline, and we would meet an upward sloping 250-day moving average. If we fast forward approximately a week, same chart. This one's dated Thursday, February 27th. 100% of this week's video is being recorded during Friday's session, when the S&P 500 was trading at 58.96 intraday, which represented a 4% drawdown from the recent closing high up here. And if the market decided to backtrack to an upward sloping 200-day moving average shown in gold here, that would be roughly a 7% drawdown. None of that particularly alarming within the context of an uptrend. Having said that, we never want to get complacent or assume that the market's going to remain in an uptrend. We shot into this gap during Thursday's session, and intraday on Friday we were back above the gap mentioned in this tweet. Always good to have reference points. During Thursday's session, the 50-week moving average shown in blue came in at 56.35. We overshot that level in 2023 and then bounced immediately, shot back up in a bullish manner. So hypothetically, if we decided to backtrack to the 50-week, that wouldn't be overly concerning, but it's also good to keep in mind that we're trading well above an upward sloping 200-week, and if we decided to backtrack all the way to the 200-week, that's a significant and bear market-like drop. So back to 56.35 represents about an 8.3% drawdown, and during Friday's session, we were roughly 4% off the recent high. Now, this is a constructive chart that we covered in early January. It's dated January 2nd. Is the NASDAQ composite relative to the S&P 500. When you're above these colored lines here, it's telling you the probability of this drawdown being over is higher, and the probability of resuming the prior uptrend is also higher. If we look at a similar chart using similar concepts as of the close on Thursday, you can see we were still well above numerous and relevant anchored weighted average price lines. Those are the colored lines. This orange line here, we closed above it on Thursday, is tied to this 2021 peak. This purple line here is tied to the bear market low. We closed on Thursday above both of those relevant lines. The fact that multiple lines converge in this area tell us it's an important region, and we would learn something about bearish probabilities relative to the uptrend resuming if the ratio moved into this white space down here, and more importantly, if it breached this orange line here that's tied all the way back to this low here in 2016. You can see we held at that area here, we held here, we had some hiccups near that area here, and we're trying to resume this uptrend that began in 2016. As of Thursday's close, this chart said, try to be patient and see how it unfolds. Same basic concepts here. This is the bear market low here in 2022. This is the peak prior to the bear market that occurred in this ratio in 2021. This is AIQ, the Artificial Intelligence and Technology ETF, relative to SPY. Again, all of this represents an area of possible support for the ratio, and the fact that we've moved into this white space area here, which looks different from all of this, is telling you that we're trying to flip this downtrend back to an uptrend. And that's relevant because AIQ is heavily weighted in the tech sector, communication services, and consumer cyclicals. Those are all market leaders. So if you're a stock market bull, you want this breakout to be a successful breakout rather than a failed breakout. And as of the close on Thursday, it unequivocally still looked like a successful breakout. And this was another chart that said try to be patient. Another try to be patient chart as of Thursday's close. You can see here in Q4 of 2018 when the S&P 500 for the most part entered a bear market because we dropped just a hair under 20% in here. You can see the ratio of defensive staples to SPY broke this downward sloping trend line right in here, and that's in the early stages of this decline that ended on Christmas Eve 2018. Similar situation here when we had the 2022 bear market. When the ratio broke this downward sloping trend line right here in late 2021, that was not a particularly good sign. If we look at the same ratio as of Thursday's close, we had not yet broken this downward sloping trend line, and we were not above the downward sloping moving averages. If this morphs into something more like this or this, concerns would increase. That may happen very, very soon. It had not happened yet as of Thursday's close. Similar concepts if we look at the same ratio with anchored weighted average price lines, the colored lines. This looks complex, but it's easy to understand. When this defensive ratio is rising in late 2021, early 2022, that's bearish for the stock market. So this is the look that we want to avoid. You can see early in 2022, we start to make a run at this purple line from the prior high. That would be similar to this line here, which comes in at this level in the present day. And then you take another leg down here, and you can see it acted as resistance here and here for the most part. But then early in January of 2022, we take out the green line. That will be similar to this drop here and this line here. It acted as resistance, but we're still well below that line. And we have numerous downward sloping anchored weighted average price lines, the colored lines. You can see here they start to turn up. They turn flat and turn up. We don't have that here. They're all sloping downward. So if this ratio gets into these lines, concerns would increase. And if these lines start to flatten out or turn up, as this green line did in Q1 of 2022, concerns would increase. The last thing this ratio did was make a new low, and it's not even remotely close to making a relevant higher high. This too was as of Thursday's close. We're not making any assumptions about what this chart's going to look like in the future, but it too said try to be patient as of Thursday's close. Now let's switch over to a daily chart of SPY, the S&P 500 ETF in isolation. As of the close on Thursday, we were still above the election gap here. It's very, very easy to remain patient as long as any ETF or stock remains above this gap. It gets harder to do so if we give up this gap. But you can see we closed well above the bottom of the gap on Thursday and well above an upward sloping 250-day in black and 200-day in gold. These dotted lines also represent areas of possible support. What once acted as resistance, may now act as support, intersects with those upward sloping moving averages that we just mentioned, and what once acted as resistance and here did act as support here and here. So concerns would increase if SPY can't make a stand at or above these levels. On a relative basis, tech has been weak. It's really nothing new and not particularly surprising when we had this level of outperformance here. However, if we look at XLK relative to VU, the S&P 500 ETF from Vanguard, really all we've done is come back to an upward sloping 200-week moving average in red. We've also come back toward this upward sloping trend line that acted as support here, 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 and potentially here. And that intersects with the 200-week moving average. We also have areas that have acted as prior resistance here, 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 and here, and support here. And all of that intersects in one place here. So it doesn't make a lot of sense to overreact when this would be a logical area between here and here for this ratio to make a stand. That may or may not happen. But at this point, we still have a bullish breakout above this level here. This is the peak prior to the bear market. And we've been consolidating above that level for some time. Leadership concerns would increase if the ratio moves into this area here. The longer in the area, the more concerning it would become. Same basic concepts here. Now we're looking at an anchored weighted average price chart. Again, the colored lines. See that area? Those lines were relevant in here. This was that battle area from calendar year 2023. And all of this consolidation, again, above this high here. Concerns about leadership would increase if we move into this white space. The longer we stay there, the more relevant it becomes. As of Thursday's close, this said, try to be patient. And in the context of a bull market, we really want to see significant damage on isolation charts, XLK in isolation. You can see the rally here off of the October 2023 low, the current uptrend. XLK made a stand above the pink line here, twice near the line here and here. Well, as of the close on Thursday, we're still above that upward sloping line, and for the most part, XLK's been in a wide trading range. If it starts to take out these lines here, concerns would increase. If we look at a chart with moving averages, we're coming back and testing on Thursday an upward sloping 250-day moving average in black. You can see we overshot that level here in August of 2024 and held. Now notice how far away XLK is from the 250-day here. And recently we've been near it 1, 2, now 3 times. That unequivocally is evidence of a waning trend, and it's relevant. It tells us the probability of this trend rolling over is higher in this window here relative to this window back here. So we have to keep an open mind about XLK moving into the white space, and that may happen very, very soon. It hadn't happened as of Thursday's close, and it had not happened intraday on Friday either. Your quantitative models and the charts you use, they should help you make decisions, including choosing the do-nothing alternative. This is a tweet on the left side of your screen from January 1st of this year. And for the most part, it says we don't have to get too concerned as long as this ratio holds this breakout. And the chart here is Friday intraday from January 17th. We covered this in a prior video. This is what the same ratio looked like on January 2nd, a chart that we covered in the January 3rd video. And if we look at the same chart with the high-low close bars as of the close on Thursday, February 27th, you can see we came right back into that relevant area that we highlighted on January 1st. So this is telling us to pay closer attention, but it's also saying be patient. This still looks like a successful bullish breakout above this level and above this level. And if we look at the same chart intraday on Friday, but this time only plot closing prices on the chart, you can see intraday on Friday, the ratio right here is above this level here and above this level here, levels that we noted on January 1st. We're also above this level here that acted as prior resistance, and we're above this upward sloping trend line that's acted as support 1, 2, 3, 4, 5, 6, 7 times in the past. So similar to some of the other charts that we've looked at, there are numerous areas and regions and reference points for possible support right where the ratio is trading during Friday's session. And the outcomes here could be significantly different. We know the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. In this case, we still have a chart that unequivocally leans towards bullish breakout. And if that's true, that means this ratio could run a long way. So we don't want to overreact. Having said that, we also know that failed breakouts can run rapidly in the other direction. So the outcomes here can be significantly different. Thus, it's in our best interest to try to remain patient and see how this plays out. If we move into the white space, the longer we stay there, the more relevant it becomes. And if it starts to look something like this, a rapid plunge, this is what we saw in January of 2022, that's not what we want to see. We just don't have that yet relative to breaking down. Notice this plunge slices through a flattish 250-day moving average in black. Right now, we're coming back to an upward sloping 250-day moving average in black. And during Friday's session intraday, the ratio was up 0.21% after being down significantly after the open on Friday. So it does appear that this area, at least in the short run, is acting as support. As always, we're not going to make any assumptions about what happens next. We trade the chart in front of us. So the daily chart of the S&P 500 said try to be patient. The chart of the NASDAQ relative to the S&P 500 said try to be patient. The ratio of artificial intelligence and tech to the S&P 500 said try to be patient. XLP relative to SPY said try to be patient from multiple perspectives. SPY holding above the election gap said try to be patient. XLK relative to VU near several areas of possible support said try to be patient. XLK in isolation on the same side of the ledger. The ratio of growth stocks to value stocks, same side of the ledger. And our quantitative scores during Friday's session align with all of that. We do see some deterioration in these scores, but this long-term score within the context of a secular trend is the more important score. This deterioration here is very, very similar to what we said here. There's no question we have evidence, widespread evidence, of waning momentum, telling us to pay closer attention with an open mind. It is possible that some of these trends are going to roll over. It just hasn't happened yet. But like the still upward sloping 250-day moving average, the long-term trend score is telling us we really don't have significant deterioration relative to longer-term time frames. These numbers are saying similar things. A secular trend score of 100 is saying similar things. These scores are intraday on Friday. This model was scored when the S&P was up approximately 8 points. This model was scored when it was down 15 points. So this deterioration here and these rising numbers here, those are good things. They help us keep an open mind about worse than expected outcomes. But the scores that we have and the drawdown that we have thus far, based on market history, the way markets trade within the context of a secular trend, they too are on the side of the ledger that says try to remain patient and don't make any major changes to your portfolio. If we were to go back to the IWF-IWD ratio, the one that we tweeted out on January 1st, same message here when we look at the AWOPs. The colored lines are upward sloping. We're still above these lines, the green and the purple from this key area in here, and we're still holding the breakout above this level that dates all the way back to 2020. Everything that we just said about the last chart applies to SCHG growth relative to SPY. The last thing the ratio did was make a higher high while holding a bullish breakout above these levels. You can see the ratio has stayed above this pink line during the current rally and has made a stand near the purple and black lines numerous times. As of Thursday's close, we were still above all of those lines, telling us that we really don't have a lot of evidence that says this uptrend has flipped at this point. Like all the other charts, the deeper you get into these areas of possible support, the more concerning it would become. Very similar to the XLK VU chart. SCHG is in George relative to VU, the S&P 500. Thursday's close, saying try to be patient. Also noteworthy, we had an overshoot relative to this trend line here, and that overshoot occurred in 2023. Markets like symmetry and parallel lines. It's possible if we overshot in the present day that we could come into this area here. And even if we drop into this area here, we're still above an upward sloping 200 week. You really can't find many long-term charts that look this healthy on a relative basis, relative to the S&P 500, in terms of where the ratio is compared to the 200-week moving average. For example, this is the same ratio, but we just swapped out growth stocks and replaced it with small caps. This chart is moving from the upper left to the lower right. This chart since 2017 has been moving from the lower left to the upper right. And I just said markets like symmetry. This is the point right here that kicked off the 2022 bear market. It would make sense potentially that we come back near that area. And that's what we're doing now. Look at the wild swings in here. There's a lot of government interference into the free markets. And that dates all the way back to COVID and pre-COVID, when you have negative interest rates around the globe and zero interest rates. That's why you're getting these wild swings. If this bullish breakout were to fail and this ratio were to move in this direction, that would be highly concerning and something that we would take seriously, especially if you get into this region here. Just a few short weeks ago, home builders looked like they were holding a very long-term breakout relative to the S&P. They too have come back to the area where we had the inflation plunge in early 2022. So if it can make a stand here and bounce, that would be a good sign. But you can see the deterioration on this chart. The ratio is now below a downward sloping and rolling over 200-day moving average, hence why we've cut the positions significantly. Not a lot of evidence at this point that the equal weight S&P 500 is flipped in terms of its long-term downtrend relative to VU or SPY. Industrial showing some improvement, but still below a downward sloping 200-week moving average in red. It's noteworthy that XLI industrials relative to VU did jump above the 200-week moving average in 2017, a year marked by the Trump trade. So it wouldn't be shocking if we popped out here. If we look at the AWAP lines, the colored lines, XLI outperformed XLK significantly as inflation concerns increased in 2022. The moral of the story here is if we compare similar colored lines to the turn in early 2022 and the present day, we just don't have a lot of evidence yet that the present day is as concerning as early 2022. If we move into this area here, that would change and concerns would increase. Chart on your screen is dated as of the close on Thursday. Don't let this date here fool you. That's where the cursor is on the chart. You can see this is early 2025 here. Yes, foreign stocks have been outperforming in recent weeks for about 8 weeks, but as you can see, ACWX foreign stocks, it's a global ETF, and you remove the United States. Here's the country breakdown. Has been outperforming, but it's done little to nothing to flip the long-term downtrend. And for us, thesis says we're in a secular bull market that could last until 2034, which is approximately 468 weeks out. So that's the time frame that we care about We're not trying to chase counter trend moves or chase counter trend moves. Right now, this looks like a counter trend move that's occurring within the context of a downward sloping 200-week moving average. And what about the theory that half of the United States is very, very concerned about the current administration? What happens if they pull out of the stock market? Well, that's a fair question. However, we could have asked the same question numerous times during Democratic and Republican administrations. About half of the country has been unhappy with who's ever in the White House, and yet the stock market has performed just fine. And historically, the stock market has not performed significantly different whether there are Democrats or Republicans in the White House. And if the current administration and their policies, tariffs, end up being a problem, then it will be reflected in the charts, and it will be reflected in deteriorating scores. And the scores have deteriorated somewhat, which helps us guard against complacency. And in terms of market participants being fearful and rushing into bonds, yes, bonds have outperformed down here in recent weeks, but you can see it's done little to change the look of the long-term downtrend. A diversified basket of bonds remains firmly in a downtrend and below a downward sloping 200-week moving average relative to the S&P 500. If we get a spike like this, then that would be useful information. We just don't have that yet. Now, we have some exposure to gold, and this is why we're really not in a rush to get rid of our gold or add to it. The ratio of GLD, physical gold, to VU, the S&P 500, has not made a new relative high since 2022, telling us in this region here, it's not particularly advantageous to own GLD over VU, so thus we would rather just hold on to VU. And if market participants were fearful and that was reflected in the demand for gold, it just hasn't played out that way. During Friday's session, GLD was underperforming VU by 1%. And we know we have some concerning figures coming out of consumer confidence surveys. However, the bond market, the credit markets just really don't share that concern. This is high yield bonds, JNK. This is what risk off looks like. This is the rollover look when a long-term trend rolls over in January of 2022. And this is what it looked like after the market sold off hard for 5 consecutive sessions, hovering around an all-time high. Another look at the credit markets. This is also a form of a poll concerning, are we concerned about a recession? Are we concerned about a major slowdown in growth? Are we concerned about a financial crisis similar to 2008? When we look at the chart of credit spreads as of the close on Wednesday or Thursday this week, the answer is no. There's really just not a lot of movement here in the credit markets screaming we're concerned. Now that may change very, very soon. It just hasn't changed yet. The semis got wildly extended here, so it's not surprising that we're coming back toward an upward sloping 200-week moving average. And this also tells us there's an additional risk in terms of downside here. We could still fall on a relative basis quite a ways and remain above an upward sloping 200-week moving average. And not a good look here on the relative chart. We just recently, in 2025, broke above these lines, made a new multi-week high, and then we reversed sharply and made a new low. That would be the bad news. The good news is, if we draw a trend line from this high and into this area here, all of this is occurring above the dotted line, and all of this is occurring above the AWAP lines, and we've come back to this line here tied to that key area. So these charts leave some underperformance at a minimum on the table for semis. It's a possibility. But they're not telling you that the relative outperformance trend, the long-term trend, has flipped just yet. If we look at SMH in isolation, it's been in a wide trading range. That would be the good news. The bad news from a risk perspective, if we break below these levels here, we're still quite a ways from that upward sloping 200-week moving average, just something to keep in mind. And moving back to that level, it's not unusual. It happened in October of 2022 during a bear market. This was the look of SMH a week ago. You could see we were still above an upward sloping 250-day moving average. If we look at the same chart as of the close on Thursday, it's looking concerning. But sometimes markets overshoot. And if we overshoot and pop right back up into this area here, that would be a good sign. If we continue to move in this direction, then that would be noteworthy as well. It's also noteworthy to get to a full bore bearish look. Price needs to be below all the moving averages, and the fastest moving average needs to be on the bottom. That's not what we have in the present day. We still have the fastest moving average near the top of this stack. So this is concerning, and there's no question momentum has been waning significantly. If we look at a DeMark chart, near the close on Thursday, we came back to the red diamond here. It's an area of possible support. During the session on Friday intraday, that was acting as support. And if we look at SMH in isolation and look at the anchored volume weighted average price lines, back to that 2023 low here, still trading above that red line as of the close on Thursday, saying try to be patient. We made a stand in a similar area here, and made a stand near the purple lines here and here. So if we push into this area here, we would learn something. Right now, still looks like a trading range in here holding above these lines. An ARKF, if we compare the look of the moving averages and price over here to this look here, we're really not close to morphing into something that looks like this, which would be late 2021, early 2022. As of the close on Thursday, still trading well above an upward sloping 250-day moving average in black. And this still looks a lot more like a full bore bullish look relative to a full bore bearish look. The NASDAQ technical index present day doesn't look anything like Q1 of 2022. In fact, we're holding the breakout above this level, and we're above all of these moving averages. Some deterioration in leveraged loans. This would be similar to looking at credit spreads or junk bonds. This is a zoomed in look at price over 6 months, but this doesn't look anything like this in 2022, and this doesn't look anything like this waterfall decline during the COVID sell-off. You can see during this correction in 2023, the NASDAQ in isolation came back near the 30-week, the 40-week, and the 50-week in green. We did something similar here in September of last year, and as of the close on Thursday, we had come back to those upward sloping weekly moving averages. And yes, momentum looks weak in here, but it doesn't look significantly different than this weak look in here, and all of this occurred above the zero line, and all of this is occurring above the zero line. What does that tell you? It tells you that this is thought to be a counter trend move within the context of an existing uptrend. You can see it looks significantly different during the bear market. All of this is occurring below the center line. So another weekly chart of the NASDAQ. This is during Friday's session around lunchtime on February 28th. You can see during this uptrend here, it's not unusual for weekly RSI to come back near these blue lines, which is what we're doing in the present day. Having said that, a little bit of an overshoot here on CCI below this level here, telling us to keep an open mind about additional downside. That would be similar to this correction here. That would be the bad news. The good news would be that eventually we went on to print a higher high. So kind of a mixed bag here on this one. This look over here would align with this look here. This is not a great looking chart. And it's also telling us we should be open to the possibility of additional downside. Also important, when we say these charts tell us to be patient, you can't make the assumption that patience means everything is fine. Not the case. The fact that we're back here tells us everything is not fine. If we had a clear and convincing breakout, we never would have come back here, and we wouldn't be back here again. This tells us we should pay very, very close attention with an open mind about a wide range of outcomes. A massive rally in this direction, or a devastating failed breakout look and a plunge in this direction similar to this plunge or this plunge. Because if we look at a chart like this and we get complacent, that means we're extrapolating. We're assuming that it's going to give us the same message next week. We don't know that. We don't even know what this message is going to be at the close on Friday. During the session on Friday, it still says be patient. The NASDAQ 2 came back to the election gap here during Thursday's session. This chart is as of the close on Thursday. On Friday, we're trying to make a bounce near a logical area, which also coincides with this high here from July of last year. It's hard to make the argument that it would be favorable if we lose the election gap and or this high from last year. This is an important intermediate term area. Doesn't mean we're doomed in the long run if we lose it, but it absolutely says we should be open to additional downside if the current bounce fails. And if we look at this weekly chart as of the close on Thursday, you can see we are trying to make a stand near a logical level. Made a stand here, here, and here. We're back there. What once acted as resistance, what once acted as a stall and support may now act as support. Intermediate term patience is not the same as permanent patience. For now, this too is saying we can afford to be patient in the short run. We've covered this chart numerous times. Energy, XLE relative to tech, this would be the look that we want to avoid. This chart is dated February 13th. If we zoom in on the look we want to avoid, this chart is dated January 21st, 2022. And if you go through this list, you are checking all of the bullish boxes. And those are bullish boxes for inflation fear. If we look at the same chart, as of the close on Thursday, the ratio is rising, but we can't check any of the bullish boxes as of Thursday's close. That doesn't mean that everything's fine. It just means, based on the chart in front of us, like many of the other charts, there was nothing particularly alarming as of the close on Thursday. If this morphs into something more like this, then concerns would increase, and it absolutely may do that. It just hasn't done it yet. And why is that relevant? Oh, you're waiting. This information here on January 21st, 2022, that's valuable information. The market doesn't bottom the S&P until October, several months later, and the NASDAQ doesn't bottom for almost a year. So we can afford to wait a little bit. If there's going to be a devastating bear market, it's probably not going to happen in 2 trading days. Thus, the moral of the story this week is intermediate term patience. We give the long-term uptrends the benefit of the doubt until the charts say otherwise, until the model scores say otherwise, until the market's drawdown says otherwise. But intermediate-term patience is not the same as permanent patience. This is being recorded after lunch on Friday, purposely. Why? We're near a possible inflection point, and it's important that we pay attention to the market this afternoon for our clients. And to give you an idea of how seriously we're taking this, we have trades queued up right now. Sell orders. Based on what we know right now, we will not be executing any of them. But we have them queued up because we don't know and we're not making any assumption about what today's close is going to look like. It never hurts to be prepared. And we all know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.